Welcome to TheoTrade. This is Don Kaufman. It's January 10th, 2025. Here we are on a Friday afternoon. Just about 50 minutes left to go in this trading week. The S&Ps once again getting rocked to the downside. It's to the tune of 1.3%, but I got to tell you, I don't mind looking at the screen and seeing the S&Ps off some 81 handles. NASDAQ down just about 300 right now. Dow getting hit for good 650 points, but wow, the Russell really kind of taking it on the chin over a 2% decline. Look, let's get right to it here, of course, on the TheoTrade weekend update. The bond conundrum. And this is really driving markets right to the edge. Now, I'm going to explain to you exactly what I mean by this, if you will, kind of bond conundrum that we're in. Before we get there, because, again, I know a lot of people tune in, they're like, I don't even trade bonds. But you got to understand that it's okay that if you're not trading bonds, like I am, but it's okay if you're not trading bonds. But you got to understand that that's the driving force, okay, behind the beast right now. We're caught in this just wild kind of bond feedback loop, which again, that's what I'm going to detail here in a moment. Before we get there, though, in last weekend's update was like, hey, enjoy the bounce back and get ready for another smack. Well, here we are precisely a week later, and well, the markets are clearly getting smacked. In fact, we talked about a lot of really specific ideas last week, and most of those actually played out quite nicely. But the biggest one is the key level inside of the S&Ps, and I want to start with that right now because I mentioned this in quite some detail. Where we close today's session is rather critical. And I want to say it again, where we close today's session is rather critical. What you're looking at on the screen right now, and I'm just going to zoom into the most recent contract. This is and again, I'm going to detail the exact level in here. This is the S&P futures, right? And you're looking at a 30-day 1 hour. And we had kind of signified that this level right in this neighborhood here, which was 59.11. Now I'm going to go ahead and I'm going to actually draw a line across your screen, literally at 59.11, just so you can get a feel for it in here. But the 59.11, right in this neighborhood here, we've pierced through it. Okay, and we've come back to it a multitude of times in today's session. Nevertheless, we're well below it. If we close below that, at least for the time being, it's hideously bearish. Like there's no other way to portray this. It's hideously bearish for the S&Ps. But again, this is actually being caused by this bond kind of conundrum that we're in, which I'm going to get to here momentarily, right? So the S&Ps at this point are just downright bearish. Okay, we broke under the 59.11. Good, we checked that box. In fact, you can even bring up 180-day 4 hour. I'll put my mouse kind of right on this 59.11. This is not contract adjusted. But you get a feel where this is kind of a breakaway spot for the S&Ps. You're below that 59.11. We can start to actually spiral a little bit out of control. Now, what brings up considerable concern, before I get into the bonds, what brings up even more concern than the S&P right now is I actually don't like where volatility is. I'm watching volatility futures, and the volatility futures, they kind of peaked. I mean, they were ripping though, like, we're 19.5 up here. Okay, and I'm just showing you volatility futures because I want you to understand they're at 19.5, and even as the market's actually subsided lower, I mean, yes, we're off the lows of the trading session, but the bond, marketplace hasn't really changed that much today, so that's not going to be the driving factor, at least right now. But the one thing, again, that leaves me perplexed is that volatility hasn't picked up more. Now, granted, there's still 45 minutes left in the trading session, so maybe the volatility starts to take off. Okay, but as I was saying, like right now, like it leaves me kind of on the edge of my seat over here in an uncomfortable spot because you do have the S&Ps down 1.5%. They're down 90 handles. Again, we're off some of the session lows, but the volatility is like, it's just kind of like taking this in stride. I don't like to see that. It's intimidating at these levels. And I put that literally in my notes, that volatility was intimidating. What's intimidating about it? I'm going to tell you exactly what's intimidating. Like, I don't want to leave anything to chance. Okay. Forget about these 12-day vol futures. Screw it. They're dead, right? You got to come in here and you got to start to really look at the 40-day, the 67-day, and the 96-day. This is Feb, March, April, May. Let's even go all the way out to May. Let's just go for it. And basically what we're looking at right now is a volatility skew that's completely and totally like, it's flat, right? So you have this like horizontal volatility skew. And why is that intimidating? You're like, yeah, whatever, man. I don't read geek. Okay. I'm going to actually read it for you. What's intimidating is basically, and I froze the screen right now, the market's basically saying we haven't even seen volatility yet. That's why it's intimidating. And you go, well, when are we going to know? Well, we'll know when the 40-day, which is Feb vol futures, when they start to really exceed the March, the April, the May. And I'm just going to put it again in exact terminology over here. You got to see like Feb vol. Let me unfreeze the screen for a second here. You got to see like that Feb, okay, vol future. It needs to take off. Like if it was trading at 22 and then like that March contract was trading, for instance, at 21, like they got to get into backwardation. Let's get all kinds of freaky. Like you got to get there, because until you get there, you know, people are like literally sitting there prognosticating about like capitulation. What is wrong with you? You're not even in backwardation yet. That's why I'm saying volatility is intimidating at these levels. You're hearing it here. Like it doesn't mean, and I want to make something clear. This doesn't mean that we have to go lower. But it does mean if we do go lower, all hell is going to break loose. And that one I want to be crystal freaking clear about on this video, because you know people are like, well, okay, so you break below, you know, the 59.11. Honestly, I figured if we broke below 59.11, which we have in the S&Ps, that's when we were going to go into backwardation. We haven't. Now you got to be intimidated, because the market's basically saying at this point, like, oh no, like we haven't even hit our stride in terms of vol. Okay, and you know you can further that with the VIX. The VIX is like waking up from like a nap over here. Okay, it's slow. Like we haven't actually spiked on volatility at all. So those of you that are sitting there, oh yeah, this is some big sell. You ain't seen nothing yet. I'm going to make that clear. You ain't seen nothing yet in terms of sell side activity. They're not even warming them up yet, because if we were, and if we're close to, you know, a capitulation situation, you would see volatility inverting here in a big way. And that is one of the biggest takeaways over here. Now, okay, we're right on the edge. And the big feedback loop right now is bonds. So it's this crazy conundrum, and I'm just going to try to explain it in the most easy terms and pack it into like, you know, 2 minutes, because I got a lot to cover here on the weekend update. So the bonds, okay, are selling off dramatically. And I keep telling you guys, I want to establish a long bond position. I'm going to buy the living crap out of it. The fact that they're down a point today, beautiful. Okay, I'm selling more bond puts into this. I don't mind showing you guys too. I'll tell you exactly which bond puts I am in over here. So if you look at my ZB position, I actually bought bonds today. So I bought the bond future itself, okay, and I sold another put in the bonds. And you're welcome to look at my positions. You guys can always freeze the screen back up. Okay, and you're like, oh, but you're down $500 in the bonds today. Good, okay. Bring it, bring the pain, because you're going to have to take a little pain in the near term over here. Okay, I can't tell you what the timing of the bonds looks like, but here's the wild bond conundrum. Okay, if bonds sell off, and this is why I call it, it's a bond feedback loop, a bond conundrum, whatever the hell you want to call it. If the bonds sell off, it drives interest rates higher. Okay, driving interest rates higher, well, it's actually going to drive some investors to be like, holy crap, the interest rates are pretty good right now. Like, some people are going to look at the bonds this weekend. They're going to look at them and they go, oh man, I can get like 4.8% of my money for 10 years. Done. Okay. Out of the contest, and they'll bail the S&Ps. Okay. By the way, if you're not one of those, you're not, you know, you're new, because I'm going to tell you right now, getting like 4.8%. When was the last time you actually got 4.8? I got to open up a 15-year. Okay. There was only a brief and fleeting moment that we were above that number. Now, we could go all the way to 5.5. I'm not going to diminish that. I've been talking about that. But the last time that we were sustainable, okay, above like where we are right now, you know, holy crap, you got to go back to like, you know, 2 decades ago. right? When I had less gray hair, okay, and was almost kind of cool back then. Not so much anymore, but like that's how far you got to go back. So the first thing in the bond conundrum is that certain investors are going to go in here. Eventually, they're just going to start buying the bonds. Okay, but but we have an inflation print coming this week, and if anything in that inflation print is ooh, it's scary. They're going to crash these bonds, and I'm going to buy more. This could be actually the opportunity of 2025 coming up over here. But if they crash those bonds further, that's going to spiral the S&Ps down. There's another situation. Okay. The other situation is what happens if we start selling the S&Ps so hard that we start turning around and buying bonds? Any way you want to put it, this is not going to be pretty moving forward. Like the bond market has freaking had it, okay, with the fiscal situation. The fiscal situation is the debt loads are out of control. This is clearly some bond vigilantes starting to hit this marketplace. They are sending a message right now, okay, to the incoming administration. Whether they're actually listening to it, okay. But you got to understand that what's going on in the bond market right now is really, it is going to kind of handicap the incoming administration. Because as we all know from Trump 1.0, this is going to be Trump 2.0, Trump likes to tweet at the marketplace, likes to really kind of heat up the economy over there. They can't do it. They heat up the economy. And what it basically is going to do is going to cause inflation, okay? And they're going to tank these bonds. You tank these bonds, you're going to take this marketplace even lower. Good news is officially now bad news. You don't believe it? Oh, of course. Look at the jobs number this morning. What do you think caused the S&Ps to be down where they presently are? Okay, the jobs number came out this morning, dropped this marketplace like a rock, and just continued thereafter. You know, it doesn't look like much, but we were trading 59.50. Moments after that, okay, we actually traded to a range of 58.89. Yeah, that people, that happened. And okay, since that point, it has been rather spectacular to the downside. So the problem that you've got in this kind of bond conundrum is not going away anytime soon. And this is actually going to resonate right into, okay, Trump 2.0, is that they're going to face all good news can actually be very negative for the marketplace. Because if it heats up inflation, we're in trouble. And again, you have a CPI print coming out this next Wednesday. All right, talk more about that. So the bond feedback loop, it's something I actually covered while live in chat today. I'll cover more next week. And again, I'm very heavily into bond positioning right now. I'm selling puts to get long bonds. I'm getting long bonds in every way, shape, or form. I like the idea of being long bonds. Onward and upward. Okay, I'm going to give you an update. Last week, I talked about being long gold. Okay, long gold. How's it been working out on the week? Spectacular, right? So a long gold position. All right, week over week. This is actually last Friday, it's today, so it's actually long gold positions working out beautifully. Short Apple. By the way, I am in a long gold position. Okay, I am in GLD. I want to be very clear about that. You can see I've even got an order to sell in here. So I'm in a GLD position. Obviously a deep in the money spread. Okay, the other position I wanted to update you on is Apple. Okay, I told you if there's a product to be short, if you think the markets are going to go down, it was Apple. Where are we with Apple? Okay, Apple's taking big hits. Am I short Apple? Absolutely. Okay, I'm actually short outright stock in here in Apple, up about almost 6.8% on the Apple short right now. Okay, the reason I'm bringing you into the GLD and Apple updates is that correlation is kind of everything. So I've talked extensively about this. When I say correlation is everything, when correlation actually kicks in, the market is less about individual shares, like, you know, like, oh, but it's Apple, you just mentioned it, oh, but it's this. Yeah, but the point is, okay, is that when you're in a heavily correlated state, okay, which we are right now, and everything changed really at the last Fed meeting, which I believe was December 18th, right? Last Fed meeting comes out and it goes, surprise, okay, we're not going to cut rates again. And by the way, with today's jobs number was really, really good. That strong jobs number today, I mean, that just really iced the cake. The number is too strong. They can't cut rates. So the Fed is basically being taken out of the equation. Doesn't really matter what they say. Bonds are going to do their thing. It's one of the other portions of the bond feedback loop. So as I dig deeper into this, and I'm talking about correlation and then jumping back to bonds over here. Okay, look, the bottom line is that what matters in the market right now is the market as a whole. Individual stocks, okay, are absolutely worth conversation piece. We're going to talk about Meta in a moment, okay? But you want to look at major levels inside of the S&Ps because the position that you're in this marketplace is it's going to move as a whole. Okay, yeah, certain stocks are going to outperform, underperform, but we're going to move as an aggregate. What happens when you're in higher degrees of correlation from that last Fed meeting, okay, is exactly when we sparked into correlation. And I said, like traders, you got to get a grip. You got to understand, you got to shift gears. We've shifted gears. We are now in a volatile marketplace. This is no longer a friendly marketplace. People are like, it's a little correction, a little pullback over here. Maybe. I don't even care about that crap. Who cares? A 10% correction. Lots of products have already corrected by 10%. Call me when the S&Ps start getting a little crazy out there. But once you've snapped into this correlation, what you got to do is you sell the strong, you buy the weak. You sell the strong and buy the weak. What that basically means to me, like look at something like Meta. Last week I was talking about, look, if you think this marketplace is going to continue to go down, you do what? You short Apple. Okay. This week I'm telling you, if you think this marketplace is going to continue to go down, you short Meta, which I did today. So again, I take a no holds barred approach. Now Meta, but it has earnings in the next what? The earnings are actually coming out, I think the 29th off the top of my head. So I'm actually in an in-out spread for the 14-day expiration. Okay, and I'm right there on the dance floor. Yeah, we traded some size in there today. Look at that. We did almost 3,000, total of 5,000 contracts, aggregate to 2,500 contracts plus per strike. So the reason I want to be in Meta, if we continue to see some sell side activity to the broader marketplace, okay, you think they're not going to come for Meta? They have no choice. It's one of the biggest, stocks in the S&P. And this is where people they get all defensive. But my stock and Apple is going to hit 4 trillion. No one gives a crap in the middle of correlation. That's the point to be made. No one cares. They're just look, they're not just going to hit one of them. They're going to hit them all. And that's the key point to understand is that you're going to see me constantly taking positions predicated on, what's really, really strong out there. Okay. I look at stuff like Walmart, oh yeah, that's keeping up there because, the consumer's alive and so forth. And consumer confidence is still pretty good. Trust in the process that if, this marketplace continues to sell off, they're going to come after Walmart. You think they're not going to come after Costco? Okay. Of course they are. This is a great bid back in Costco to possibly be shorted, right? Big sell side activity, big move back. By the way, the big move back inside of Costco is because same store sales were spectacular right up to the point they whack it because no one gives a crap in volatility. See, I wanted to bring up same store sales in there because I'm totally aware of it and still telling you, nobody cares. There's no news, no fundamentals, no technicals. Okay. If they start coming for this marketplace, they will hit everything. Right? Perfect example here. If you take a look at the S&Ps, which are starting to backslide a little bit, what's it going to do to Meta as the day goes on? Oh, it's going to hit Meta, right? Meta is now starting to see some sell side activity. Bring the pain. CPI and earnings. Next week, okay, into the calendar we go. You've got CPI. That's a big one. If this marketplace shows degrees of inflation coming back, you're in trouble. I can't even describe what trouble is going to be, but you're going to be in big trouble in this marketplace because inflation coming back, holy crap, the Fed's basically already staved off the cutting of any interest rates. They're going to talk about raising interest rates. I mean, all kinds of chaos over here. It's a crazy week coming. There's a crazy week coming. Any way you want to put it. On top of it, there's earnings. I've actually already started trading earnings. This is a fun one. For those of you that are actually in earnings flips, I hit the Delta Fly today. Okay. Delta Fly paid 54 cents for it yesterday. By the way, I did a lot of trades, but paid 54 cents for it, exited it for $1.20 and $1.25 respectively. So it's, 120 some odd percent return on the Delta Butterfly, but I hit the Delta Butterfly. That's winner, chicken dinner on that one. There is your earnings flip. But earnings, you're going to see earnings flip in a big way starting next week. We're going to kick off the banks start coming out like JP Morgan, Bank of America, Citi, Morgan Stanley. A lot of trades to be had next week. But that CPI over there, that CPI print, that thing is going to keep me on the edge of my seat. Jobs was nothing. CPI is really going to make a difference now. Now, onward. The other trade that was absolutely huge this week, for those of you that actually join us for the 3 trades a week, on Monday, I put out an SPX butterfly. Okay, I'll actually show you the exact order here, right? By the way, in the last, this is a fun one, but in the last 30 days, I've hit 1, 2, 3 butterflies in the last 30 days. It's absolutely unheard of. Okay, I hit a butterfly for a $5 credit. That right there, 800% return. Okay, hit another one over here, paid 60 cents for it, closed it for $2. This week, paid 45 cents for a butterfly on Monday, closed today for $2.95. It's a 555% return. So those 3 butterflies, that's like enough to pay for your butterflies all throughout the course of 2025. It's huge, huge. So we've been hitting butterflies left and right, very, very consistent with that one. The one thing I also told you like last week, in fact, told you last week, like look at that volatility and expect this thing to get a little bit crazy. That's why it gave me a great opportunity to buy that butterfly early in the week, and I took it. Okay, speaking of SPX, let's cut to the chase. The SPX right now, with just about 30 minutes to go to the close, we are outside the expected move. That's one of the other things that I said last weekend is that I couldn't fathom. I know it's a 4-day trading week. We're coming out of a 4-day trading week, right? We're closed on Thursday, but I couldn't fathom that was only an $83 expected move last week. Like, look, the week that we just ended here, you realize that we were up like $83 on Monday. Okay. Obviously Tuesday spins us back around. So Wednesday was pretty moot point. We sold off, rallied back. Thursday we're closed, and here we are on Friday, kind of getting our clock clean. We're outside the expected move. So look, that's over and done with. We're through the 59.11. I mentioned that. The most important thing is, what do we look like for next week? Next week is the first 5-day trading week we've had, well, in weeks. So in terms of like a 5-day trading week, you had Christmas week. This is a 4-day trading week. Apologize. 4-day trading week. You had Christmas week. You had New Year's. Okay. Then you had this week. There was, again, these 4-day trading weeks. And here's ironic. This coming week is a 5-day trading week, but the week after that, like starting January 20th, the marketplace is closed because of the Martin Luther King holiday, right? So here we are. We're going into a 5-day trading week, and the SPX, okay, in the 5-day trading week is going to have about $120 expected move. So, well, what can I tell you about the 5-day trading week? Well, put on your big boy pants, because crap's going to get real. And the one aspect, though, I'm going to leave you with this and this, like you have a 5-day trading week, it's $120 expected move. That's huge. Really? Because right now, here we are. Okay. We're just in one trading day, and the S&Ps, as I come into this, they've already moved $100 in one day. So to see $120 expected move for the entire week, okay, it's just like that. If there's going to be a big volatility explosion, okay, here it comes. Here it comes. It is right out in front of you. Look, okay, I will cover much more about this like wild bond conundrum. It's everything right now. And as I said, I don't care necessarily if you're trading bonds. You don't have to trade bonds, although I think it's incredibly opportunistic coming up. You don't necessarily have to trade bonds. But you do have to understand that there's this vicious and unrelenting feedback loop. And whatever you might think about the first Trump administration, this next time through, this is going to be a completely different animal. So there's already a stark warning going out in terms of bond markets and interest rates, okay, and the amount of debt the United States has. There's a stark warning out there right now. You don't believe me? Look at the bond market. They're just hammering this thing, and you're caught in, again, this wild kind of conundrum. And I also, again, I want to leave you with that one last thought. The S&Ps, no matter what you might think, they're seeing a little bit of sell side activity, okay, a little like sawtooth action in here. What the marketplace is telling me is the volatility has really yet to begin. We are on that edge, people, but that volatility has really yet to really kick in the high gear. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.